the Fed, as we've been discussing, is certainly in the spotlight as worries in the banking sector spread following the failure of Silicon Valley Bank. Now, the turmoil brewing at Credit Suisse. Here to discuss all this and more, backdrop for the economy, is Rajan, University of Chicago Booth School professor of finance and former governor of the Reserve Bank of India. Thank you so much for being here, because obviously this is a confusing time with all of this going on. How does the Federal Reserve navigate all of this? What should they do?
Well, I think they have two problems, right? One is inflation. The other is financial stability. They would wish they had only one, and that was the case before Friday. Now, the betting, as you correctly said, was it was going to be 50 basis points with a strong CPI report on Tuesday. That's what we got. Labor markets are very tight still. Now, the reason the Fed sort of has probably taken 50 basis points off is that would be a pretty hard hike at this point when you have so much fragility. The question is 25 or zero. I doubt they will cut. Now, if they do zero, they will accompany it with very, very strong language saying, we're not pausing, we're just taking a break, looking at how the market settled down, and then we will potentially resume. But my sense is I would be in the 25 basis point camp. It does signal they're still concerned about inflation, and they do need to slow the economy down. Now, the question that would be on the Fed's mind is, with the financial sector turmoil, clearly, if it increases by the time they meet, they will be more tempted to zero. But also they will ask, will the financial sector turmoil and the concerns thereof make businesses more willing to lay off people, contribute to the slowing of the economy, so the financial sector turmoil will do part of the Fed's work. Now, that's not the ideal way to get the Fed's work done, but it can be part of the Fed's work, and therefore that may move them towards a zero. So what you said in the beginning, this is all up in the air, very confusing. My sense is the Fed would not want to send a strong signal that they're pausing, and they'll find some way to indicate that.
I want to draw on your experience here, having formerly been the governor of the Reserve Bank of India, also chief economist at the IMF, even vice chair at the BIS, the Bank for International Settlements, the so-called central bank of central banks. What are the types of conversations going on between Powell and some of his colleagues around the world right now?
Well, I think that people around the world want to know if the problems within the U.S. are contained. How big is this? How many banks have the problem that SVB had of lending long, borrowing short, and therefore subjecting themselves to huge interest rate mismatches, and therefore the kind of problem they saw. Now, that's the source of the systemic risk in the United States. How many small and medium banks have that kind of exposure? And do any large banks have that kind of exposure? That's what they want to know, because anything that happens in the U.S. doesn't stay in the U.S., it transmits across the world. Now, that said, I think the problems with Credit Suisse are a little different. Credit Suisse is a bank in search of a business, and it hasn't quite found that. And as a result, the turmoil in Europe, and to some extent amongst the big banks in the US, is how much exposure do you have to Credit Suisse if it melts down over the next few days? So that's a different concern from the interest rate risk exposure that is the concern among small and medium banks in the US.
Well, and then when you speak about Credit Suisse as well, are there implications for the ECB, which is meeting tomorrow?
Absolutely. And my sense, again, is it's going to be a tough call for the ECB. They've signaled as hard as they can that, core inflation, that is inflation without food and fuel, is too high in Europe. They need to bring it under control. And they've signaled as clearly as they can that they will do 50 basis points. It's going to be hard to climb down from that. I think they'll watch what happens, tomorrow morning while they're talking. But yeah, it's a tough decision.
I want to take a step back as well when we talk about the path of the economy from here. A note caught my eye this morning from Torsten Slok, who is chief economist at Apollo. He had talked about a no landing several weeks ago, and he said when the facts change, you change your view. He is now looking at a potential hard landing, so-called, in the U.S. economy. Do you think that that's what we're in for? You recently wrote an op-ed talking about the Fed's path here and how it's going to manage that landing scenario. What do you think that looks like now?
Well, I think it's really at this point, I think the chances of a soft landing are very, very small. That it's going to be a moderately hard landing or a really hard landing, and that can come in two ways. One, inflation numbers still stay high. The Fed increases its hiking. It's not a financial sector-led slowdown, but it's an interest rate-led slowdown, and companies lay off more people. That has its own sort of momentum. As the companies see more slack in the labor markets, they feel more comfortable laying off their people, and that builds up. And of course, layoffs lead to people having to sell homes. Homes sales lead to fall in house prices. You get a sort of bad sequence of events. You get a harder landing than the Fed wants. That's still a possibility out there. The other way things slow down is this financial sector concerns increase. You have a couple of accidents happening along the way. People get very concerned. They rein back their spending because they think the economy is slowing, just as it slowed during the global financial crisis. And that does the slowing for the Fed without it having to raise interest rates much more. But either way, the landing is harder than the soft landing that many people thought was a possibility. Now, the evidence is every single disinflationary episode since the 1950s has involved, at least a mild recession, if not a more serious recession.
Just thinking about some of the broader fallout from the regional banking failures that we've had in the U.S., we've seen a flight of deposit dollars. I read one headline, $15 billion made its way to Bank of America. It looks like the disparity between the tier one and the other banks is increasing. And so with all the talk 15 years ago about moral hazard and too big to fail, we have even bigger too big to fail potentially issues now. I'm just wondering what your thoughts are on that.
I mean, absolutely. I mean, the problem to some extent is regulation is often a good thing. It evens the playing field, right? When you know that your banks are well regulated, then you feel comfortable putting your money in. Now, what we've had is over the last few years, we've had the regulations on the small and medium banks alleviated somewhat, while the regulations on the large banks are still pretty strong. They, for example, have to meet the liquidity coverage ratio needs. So when people start waking up and saying, hey, my bank has risk, they ask, well, has this been regulated? And no, they reduce the regulations on my bank. Well, let me go to a bank that is well regulated, where I know they don't have hidden problems, where they have enough liquidity, and they're too big to fail. So this kind of flight, despite all the Fed has done in reassuring depositors they won't lose their money, in allowing banks to borrow against the full value of their bond portfolios, you're still going to have businesses saying, do I want to keep my money at this bank, which is at risk of failure, or do I want to move to something which has zero risk of failure? And that's the flight that you will see over the next few weeks. I hope it is contained, but it is something that is almost inevitable given the asymmetric regulation and the asymmetric concerns that have been raised recently.
Well, Rag, on a related note, this is something we've been asking a lot of folks. Is there now an implicit guarantee of all deposits in the U.S., no matter what size? And then what are the implications of that?
For now, yes. The problem is, obviously, this creates moral hazard, no matter which way you spin it, because large depositors are not now worried about the risk of putting their money in a bank, even if it is, quote unquote, uninsured. So how do you restore a sense of, that my money will be at risk? And that means that you probably have to implement stronger regulations at the banks so that the kind of systemic concerns that are at play here How many banks have exposure to interest rate risk that I don't know about, which then cause the potential contagion? If it was only Silicon Valley Bank, you could have let it go, maybe dealt with the problem of entrepreneur funds being at risk. That would be a separate issue. Now you've offered a blanket guarantee because you don't know, and the public doesn't know how far the risks spread. And that's why it's very important to ensure systemic risks are contained, which means much stronger regulation on things like duration risk. Everybody's asking, how on earth did this bank take so much exposure to interest rate risk without the supervisors noting? We will have to have stronger regulation on that. You would have to, perhaps put the liquidity coverage ratios, which are protecting the large banks, on these smaller banks. Those are things that will be contemplated, I think, as we come out of this, and will be necessary to restore the sense that depositors, large depositors, are at risk. There's no reason why the taxpayers or even other banks should be paying for them.
Right, which is what's happening right now. Raghu, this is really, really helpful perspective, and we really appreciate your time this morning. Raghu Rajan, University of Chicago Booth School Professor of Finance. Thank you.